Hello and welcome to Weekend Investing Daily Bytes. We are shooting to episode 289, and today we are going to shoot the second part in our series, Can You Stay Calm in the Market Falls? We did the first part yesterday and today is the second part. First, a look at the markets. The global contagion move down continues. Yields on the US treasuries as well as everywhere else continue to go up. US dollar continues to strengthen. It is nearly 115 now, the dollar index. Indian rupee continues to fall. We are near 82 already. And essentially, there is a sort of a deflation of all assets everywhere. So, all currencies against USD are getting devalued, and the markets in all these economies are also coming off, whether it is stock markets, whether it is housing, so on and so forth. And secondly, even in the US, while the currency is getting stronger, but all the markets there are also coming off. So nobody is really gaining out of this current scenario. But the structure of the monetary system, the global monetary system, is such that the rest of the world needs the dollars. So there is demand for the US dollar. And as the demand for the US dollar goes up, the yield of US bonds go up, and money flows from other asset classes towards safe haven US dollar, and that causes other currencies to weaken, and that is a sort of a vicious loop, and that can only get broken and for in the long term, if dollar dominance or dollar the global trade can happen, not so much in US dollar terms only, and if there is a balance across currencies. So it is something called the Triffin's paradox or Triffin's dilemma, if you may want to go read it on Google, that even the US is not going to benefit out of it, but of course the rest of the countries are suffering. So we don't know how and when a solution from this can emerge. Of course, currently the markets are extremely stretched, so a counter move can happen anytime, but there is no solution in sight. So pharma, IT, autos and consumptions were some of the sectors which were able to withstand the selling pressure today, but PSU banks, metals, commodities, energy, private banks, Nifty 50, everything was down. Nifty closing minus 0.87% down, and in the last week itself, you can see how many sectors are almost nearly 7 to 10% down. Pharma and IT, being defensive sectors, along with FMCG, are the least hit, and that is expected in any such crash. Mid and small cap index also were reasonably strong till midday, but they also gave up towards the latter half of the day. Nifty Next 50 was down 0.6% and all others down 0.7 to 0.87% in the large cap names. In terms of weekend investing strategies, there was hardly any outperformance. NNF10 losing the most at minus 1.1%, and MI30 and MI80 just about MI30 only actually just about eking into the green, but other than that, pretty much along the expected lines with the benchmarks. Heatmap for the day extremely red. HDFC Bank, State Bank, HDFC, Bajaj Finserv, Axis Bank all down around 2%, Reliance down 2.5%, ONGC, Coal India also down 1.5% each. ITC surprisingly down 3% today. Steel stocks down 3.5%, JS Steel 2.5%, Tata Steel, Hindalco and Shree Cement also down. Adani Ports also lost minus 2%. IT universe reasonably stable because of dropping rupee. Some specific consumption stocks, Asian Paints for instance, up. Some pharma stocks, Sun Pharma and Dr. Reddy's, I think, also up. Eicher Motors was up within the auto pack, but other than that, it was pretty much a listless day. In terms of top gainers, ITI up 8.5%, India Cement surprisingly plus 8%, Gujarat Fluoro 6.5%, Asahi India and Tanla Platform also up 5% each. The ones that lost ground were Gujarat Ambuja Exports and PNB down 5%, Brightcom, Chambal and Adani Green Energy is down around 4.5%. So big names falling off. Please watch this part 1 of this series that is available on YouTube yesterday. So that you can have more of a context of today's topic, because it is developing on what we saw yesterday in this series. So today we will see how a SIP would have helped you stay calm had you been invested in Nifty for simplicity's sake. So this is the Nifty chart from the last 20 odd years, and you can see that while when you look at 20-year charts, they look very simple and easy. You should have bought here at 1,000 and you made 16x in 20 years. So what could have gone wrong? You could have just stayed put. But once you are on a day-to-day basis inside these drawdowns, that is where you really come to know what kind of a confidence level you need to sustain such falls. And lump sum investments therefore become extremely difficult, because you don't know when you bring in the lump sum what kind of a move you will get in the next few years. So we've segmented this in several segments. So February 1 to 4, this was about 3 years and 8 months. A CAGR would have yielded about 8%, and XIRR, if you were sipping every month, would have yielded to 23.5%. So a huge sort of a confidence booster and better returns if you did a XIRR SIP there. And then in the next phase, with the bull market on, 3 years and 2 months leading to December 2007, this period, if you had done a lump sum, you would have made 48%. XIRR would have made 51%. Not much difference, because this is sort of a singular one-way ride, but XIRR doing quite well here as well. In the next phase, it was more of a dip and then come back here. So it's sort of a V-shaped recovery. If you invested here lump sum, you would have made nothing after 6 years and 1 month. And no, this is 1 second. It extends till 2014 actually. So 6 years, going from 7 to 14 would have gone here with lump sum at 0.13 and XIRR at 7.45%. So nothing great in the XIRR also, but still you would have made at least more than the bank returns, despite market doing these two ugly drops here. And then in the January 18 to October 22 years and 9 months, again there was no return despite having a large COVID fall here, but no net returns of plus 2% on lump sum, but XIRR was up at plus 6% here as well. And then in this last phase, from October 20 to now, CAGR would have been at plus 21% and XIRR only at 11.9%. So in most cases, you would see that XIRR is higher, and it would, given that the expectation that in most such circumstances, doing SIPs will yield you better returns than trying to time and bring in lump sum, will keep your investing in a calm state, and you will not be worried too much about it. In terms of where we are in terms of the market, we peaked somewhere in October 2021, and then we have been jiggling around here, and we were close to this point where we thought that we may break out and go upwards, but we didn't, and we have now broken below the 200 DMA. So that is not a very encouraging sign right now. So we need to consolidate and find a new bottom and then come back up again at some point. But as of now, it doesn't seem like the all-time high is anywhere near us. Another sort of insight here is the shock that the system is having to bear. So after the largest ever stimulus in COVID, the interest rate hikes in this cycle, and this is US data from Bloomberg, so has been the fastest. So this is comparing the current cycle, where we have gone from virtually 0 to 3% interest in the US. If you compare it to 1994, it took 12 months to reach here. In 1983, it took 15 months to reach here. In 2004, maybe around 18 months to reach here, and then it went on for 25 months. In 1999, it was very much shallow, only 12 months and only 1.25% hike. And in 2015, hiked to about 2%, but over 37 months. So the previous interest rate hike cycles were all much shallower compared to this extremely rapidly, upstanding shock to the system. And what this will do, mortgage rates in the US are already 7%. So, housing will crack badly, and that will have all kind of recessionary impacts on the trickle down impact on the economy. And again, some QE in some format will have to come in once the government and the Fed realizes that the people are on the street. So it is looking pretty ugly right now, and this is another ugly, ridiculous sort of a situation where these are 40-year UK bonds, and if some retirees were told somewhere in 2021 November December that you're coming to a retirement, why don't you buy these bonds, and these are safer than stocks, those guys are now sitting at a 75% drawdown. I mean, it is unbelievable that people who are sold bonds think that bonds cannot shave off most of your capital. This is a real example, and UK is not a developing country or a emerging economy. It's considered to be a developed nation. So a person who got in with, let's say, his entire life saving of a couple of £1,000,000, being promised 0.5% of yield on that, and now he's down 75% on his life savings. I mean, this is painful and crazy actually. So we are living in a crazy world, and there is no two ways about it. Another thought from today's Twitter session is that every single rupee that you have in a portfolio has a decision dilemma. What it should be doing. Should it stay invested? Should it go out and buy you something that can serve you some purpose in your real life, or should it get passed on to whoever your monies will get passed on to you after you're gone? So this is a more philosophical question, and that's why I keep saying that keep spending on yourself, keep spending on your family, keep spending on your education, keep pampering yourself, because you never know what's going to happen. I mean, there is no guarantee that your portfolio will not go 75% down, as I showed you in even the bond case. So help your money make good decisions, help yourself make good decisions, have a good life, and also keep investing on the side. So thank you so much for your time. This was a quick daily bite on a few topics of importance today. The scenario is not so good right now, but we never know how quickly things can turn. In fact, UK has already announced today some sort of a QE. So if that QE starts to come around and other countries start to follow, then we'll have another leg up. So we are stuck in this QE QT situation until we find a new global monetary system, and I don't know if that comes in my lifetime or not. So thank you so much for your time, and please do share it with others so that they can make some benefit out of it. Goodbye.